Okay, so you wake up tomorrow morning and oil is worth nothing. Not $10, not $1, zero. You check the news. Free gas at every station in the country. Airlines announcing the elimination of every fuel surcharge on every ticket. Heating bills collapsing to almost nothing overnight. The entire cost of moving any product, any person, anywhere on Earth dropping to a fraction of what it was yesterday. For about 30 seconds, it sounds like the single greatest economic event in human history. Here is what the next 30 hours actually look like. Before we trace the collapse, it is worth understanding that the world already had a partial preview of this scenario. On April 20th, 2020, a specific futures contract for West Texas Intermediate crude oil did not just hit zero, it hit negative $37 per barrel. Sellers were literally paying buyers to take oil off their hands because every storage facility in America was completely full, and producers had nowhere left to put what they were still pumping. That event lasted one trading session, but in China, thousands of ordinary retail investors had placed their savings into a product offered by the Bank of China called Yuan Yu Bao, designed to track those same WTI oil futures. When oil went negative, they did not simply lose what they had put in. They received formal letters from the Bank of China, informing them they now personally owed the bank money on top of their total losses. The damage across those retail accounts came to approximately 9 billion yuan, roughly 1.4 billion US dollars, wiped out in a single afternoon. That was a partial, temporary event that lasted a few hours. Now, remove the word temporary and make the price not negative 37. Make it zero. Sustained. Global. Permanent. Here is what breaks first, and the sequence matters more than anything else in this scenario. Within 60 minutes of oil hitting zero, every energy company on the planet with outstanding futures contracts triggers what traders call a margin call. A futures contract is a legal agreement to buy or sell a commodity at a fixed price on a specific future date. Airlines buy them to lock in fuel costs months in advance. Shipping companies use them. Manufacturers use them to stabilize input costs across production cycles. When oil hits zero, every single one of those contracts moves instantly and violently against the party that sold them. The total derivative exposure sitting across global financial markets tied directly to oil prices is estimated at somewhere between $2 and $3 trillion. Not the physical oil, the financial instruments built on top of the price of oil. In the first 60 minutes, those instruments reprice simultaneously. Trading desks at every major bank on Earth start receiving margin calls larger than anything in their risk models. Stock markets halt trading as circuit breakers activate. The energy sector collapses first, then the financial sector, as bank exposure to energy derivatives becomes visible. Then logistics. Then every sector that relies on overnight credit lines to make payroll. The mechanism that froze global credit markets in 2008 when a single investment bank failed took 2 weeks to fully play out. At $0 oil, it plays out across 48 hours. Because everything in the global economy is connected to this one price. But the financial collapse, as catastrophic as it is still not the most dangerous part of this scenario. Not even close. Here is what most people never think about when they picture the price of oil. Oil is not just fuel. It is the raw material for approximately 6,000 products in your home right now. The plastic casing on your phone, the synthetic fibers in your clothing, the rubber in your shoes, the adhesive that assembled them, the packaging your food arrived in, the fertilizer that grew that food, aspirin, toothpaste, shampoo,
Tires, the insulation inside your walls, the pipes running through them. Every single one of these products runs through a petrochemical supply chain that begins at a barrel of crude oil. When oil hits zero, these products do not become free. The companies manufacturing them lose all pricing logic overnight. Nobody knows what their inputs cost. Nobody knows what to charge for the finished product. Supply chains calibrated around oil at $60 to $90 per barrel cannot function at zero. Procurement freezes. Production lines halt. New orders
stop being placed because no manufacturer is willing to commit to a price for a finished product when the cost of every raw material inside it is suddenly undefined. The global manufacturing economy does not gradually slow. It stops taking new orders on a Tuesday morning. And agriculture is where this becomes dangerous in a way that will not appear on any news ticker for another 6 months. Modern large-scale farming runs on oil in 2 directions simultaneously. Diesel powers every tractor, harvester, and irrigation pump on every commercial farm on Earth. And nitrogen fertilizer, the single input responsible for the crop yields that feed 8 billion people at current population levels, is manufactured almost entirely from natural gas and oil derivatives. When oil hits zero, fertilizer producers face an immediate cost structure that makes no sense. Shipments get delayed. Farmers who cannot get fertilizer do not plant smaller crops. They plant catastrophically smaller crops. The food system does not feel this on day one. It feels it in the next growing season. But commodity markets price it today. Agricultural futures spike violently upward at the exact moment oil futures hit zero. 2 prices moving in violently opposite directions for the same underlying reason on the same morning. But here's the part of this scenario that almost nobody sees coming. And it is the part that turns a severe crisis into something genuinely irreversible. You would assume the countries that import oil are the winners. Japan, South Korea, Germany, India, nations that collectively spend hundreds of billions of dollars every year buying oil from someone else. At zero, that bill disappears. It sounds like an enormous windfall. It is not. And understanding why is the key to understanding what $0 oil actually destroys. Oil is priced in US dollars. Every barrel sold anywhere in the world, whether it moves from Saudi Arabia to South Korea or from Nigeria to the Netherlands, is denominated in American dollars. This arrangement, known as the petrodollar system, has been the structural foundation of US dollar dominance in global trade since the early 1970s. Countries need dollars to buy oil. To accumulate those dollars, they purchase US Treasury bonds. That sustained global demand for Treasury bonds allows the United States government to borrow money at lower interest rates than any other nation on Earth. It is the mechanism that keeps American debt manageable, and the dollar the world's reserve currency. When oil hits zero, the primary reason every central bank on Earth holds dollar reserves disappears overnight. Currency markets operate 24 hours a day. They do not wait for a policy meeting. The dollar does not decline steadily over months. It reprices in real time against every major currency simultaneously. The oil-importing nations that looked like the morning's winners are now sitting on enormous reserves of a currency that just lost its most important source of global structural demand. Their windfall evaporated before the trading day closed in Tokyo. Now, consider the other side. Saudi Arabia requires oil at approximately $80 per barrel simply to balance its national budget each year. At zero, it loses its entire revenue base before breakfast. Russia derives roughly 40% of its federal government revenue from oil and gas exports. When prices fell to $30 per barrel in 2020, Russia burned through approximately $50 billion of its sovereign wealth fund in a single calendar year, just to keep the government operational. At zero, there is no sovereign wealth fund large enough to bridge the gap for more than a few weeks. Nigeria, whose government depends on oil for approximately 60% of its foreign exchange earnings, cannot simultaneously pay civil servants, import food, and service its external debt. These are not marginal economies having a difficult quarter. Several of them are nuclear-armed states or major regional powers, losing the financial floor underneath their governments in real time. The decisions made inside governments that can no longer pay their armed forces do not stay inside their borders. And here is the final reversal, the one hiding inside the headline that started all of this. Free oil that nobody can access is not free. It is worthless in a different direction. By the time oil hits zero and the morning news is running graphics about free gasoline, infrastructure required to move that oil from the ground to your tank has already begun shutting down. Refineries that convert crude oil into usable fuel begin curtailing operations because refining a commodity worth nothing while still paying hundreds of millions in operating costs accelerates losses rather than limiting them. The gas station in your area may still have fuel in its underground tanks for a few more days, but the next delivery is not arriving on schedule. The truck that would deliver it is not being dispatched because the logistics company dispatching it is managing its own credit emergency. The refinery that would fill that truck has cut output because there is no longer any economic signal telling it to keep running at full capacity. The price of oil is not just the cost of fuel. It is the signal that tells every company across extraction, refining, transportation, and distribution whether to keep operating at all. Remove that signal, and you do not get free energy flowing effortlessly to every corner of the economy. You get a system that stops producing energy while simultaneously collapsing the financial architecture that every government, supply chain, and currency reserve on Earth was calibrated around. So here is the honest answer. $0 oil is not an economic gift. It is a diagnostic test that reveals exactly how many things were only working because oil had a price. The financial derivatives built on that price, the petrodollar system constructed around it, the government budgets funded by it, the 6,000 products manufactured from it, the food supply dependent on its derivatives. Every single one of those systems was designed for a world where oil is worth something. The morning it hits zero is not the morning the world gets cheaper. It is the morning the world finds out how many things were quietly depending on that number staying above zero. The gas is technically free. The station may still be open. You just cannot get there because the currency in your wallet is having a very bad morning. And the fertilizer that was supposed to grow next season's food is no longer being produced. And somewhere, a government that funds its military entirely on oil revenue is trying to figure out how to make payroll. That is what free oil actually costs.